Greetings, my good students, professionals, and other interested parties in this channel. So it's another great time. Now we are coming across again in the tackling of various questions in advanced financial reporting and financial reporting. That is from the CASNEP syllabus. So for today, I would like to finish a question which I did partially on my previous video. That is a question of a consolidation for August 2022. So that question we did the first part, whereby it was requiring the determination of non-controlling interest. The second part was consolidated statement of financial position. So if you have not watched the first part, I have attached the link down here. So under this platform, so under that YouTube, once you click more, under the information written down here, you will be able to find the link to the first part, which was determine the non-controlling interest. So the second part was all about the consolidated statement of financial position. So consolidated statement of financial position, 14 marks. And now before we go to that route, remember that consolidation is a compulsory topic in both financial reporting and advanced financial reporting. Take it more serious whenever you come across a video of this kind. And again, from my analytics, it shows that some of you guys, you have not subscribed to the channel. So you always go through the video without subscribing. So the first thing I would wish, if you have not subscribed, just press the subscription button. It's for free. Promote this channel so that we can get to good numbers. So anyway, let's go direct to the business of today. That is the determination or the presentation of the consolidated statement of financial position. So this is according to August 2022. This is according to August 2022 sitting, Advanced Financial Reporting, AFR. So this is concerning question what? So according to my hard copy question here, of which some of you guys, you are saying that I do what? I post the questions, of which I understood that you need to have this question. Or I have attached the link again down there to this question. So you can be able to download even all the past papers from 2015 for the CPA. So you have the past papers. So no worry about that. So this is question one. This is the first question. That is question one. So it was a question whereby you find P, remittent, acquired S. So the first thing you are supposed to draw is this, the structure and the shareholding. So P acquired S. So that is according to additional information number one, 60%. So sometimes back. So remember that our financial year ends on 30th June. So our financial year ends on 30th June 2022. So it starts on 1st July 2021. When was S acquired? On 1st July 2012. On 1st July 2012. So that is sometimes back. So 60%, 60%, yes, 60%. So meaning that this was a subsidiary. S is a subsidiary to P because now the percentage is more than 50. So 50 plus 1. So when another company, that is when the parent acquires another company for a percentage exceeding 51. So the other company is called a subsidiary to that parent. Like now, yeah, this is a parent, this is a subsidiary. So there was an additional acquisition which happened. Is an additional acquisition which happened during the year. And that is what we are told in additional information number two, that on 1st January 2022, now during this year, on 1st January 2022, on 1st January 2022, they acquired a further 20%. So on 1st January 2022. So meaning that by the end of the year, when I will be preparing my consolidated statement of financial position, it means that the total percentage or the percentage by the end of that year is at 80%. Is at 80%. So I will consider those percentages. So the main thing I was trying to check. So S is which type of company to P. So S is a subsidiary. This is how the parent is supposed to consolidate subsidiaries. And that is what I will be showing on the whiteboard. While considering in every transactions which is carried out, in every consolidation which we do, which adjustments you are supposed to carry out. So let's start from the first item, that is assets. Under assets, we have property, plant, and equipment. We consolidate that. So we go to investment, financial assets at fair value, current assets, equity, and current liabilities. And remember that in these 14 marks, you can be able to score it very easily. Because in an exam, the examiner doesn't even require you to do the balancing of the question. It requires at least you get some correct entries. So here, I would say P limited, consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position. As at which period? 30th June 2022. So you write the heading there. Then you check if the question is stated in shillings or millions or thousands or even dollars. So this one is shillings in millions. So we start from assets. So we talk about the assets. So when I talk about the assets, remember that we talk about non-current assets. The non-current assets. So for the non-current assets, the first non-current asset we have is all about the property, plant, and equipment. That is the first item we need to consolidate, the PPE. I will write in short, property, plant, and equipment. So you always take the parent plus subsidiary, 16,875 plus 10 to 30. Then what you are supposed to add is all about revaluation. So under PPE, it's just few items you need to know which are adjusted here. So which adjustments are supposed to be made in the property, plant, and equipment. So what you always consider in property, plant, and equipment is adding revaluation. So the revaluation gain you add. So due to this revaluation, there is a depreciation undercharge. Depreciation undercharge. You subtract. Then after depreciation undercharge, you talk about UPFA, unrealized profit on fixed assets. You subtract. So due to this UPFA, there is depreciation overcharge, which you add back. So this one leads to this. This one leads to this. So revaluation gain leads to depreciation undercharge. Unrealized profit on fixed assets leads to depreciation overcharge. So if you would like to understand more about UPFA, revaluation, you check on my introduction, on my introductory video for group accounting. But I can mention something small concerning revaluation. So revaluation is just the difference between the fair value and the carrying amount of an asset, or with the fair value is obvious in excess of the carrying amount. So when an asset increases in value, we say that it has been revalued. So due to that revaluation, due to the value with which the asset has been revalued, remember that that value has not been subjected to any depreciation. So that is why we say, or we always say, that we need to determine the depreciation figure which is inside that revaluation. So we mean that initially they did an undercharge. So we need to determine the depreciation which is inside the revaluation. Then unrealized profit on fixed asset is due to an asset which was sold by one entity to another at a profit. Like now, the parent sold to the subsidiary, but the subsidiary never resold that fixed asset, of which we know that a fixed asset is not always meant for resale. So the other entity which received that fixed asset never resold that asset. So meaning that they never realized the profit the other entity realized. If it's P was sold to S, a fixed asset, S never resold, but P realized the profit. So we need to determine that profit which P realized so that we do what? We eliminate in his books because now S never resold that fixed asset. So the profit of P is overstated by what S never realized. So due to that sale of fixed asset from one entity to the other, you will find that both of them, they subjected the asset to depreciation. So when A was selling the asset to B, or when P was selling the asset to S, P had already charged depreciation. S receiving the asset again charged depreciation. So that is a double depreciation. So they are understating the value of the asset. That is why we add back this. So let's check in our additional information. Is it available? Is there an item out of the one I have written here? That is revaluation gain, depreciation undercharge, or UPFA, and the depreciation overcharge. But mostly I check this if there's a set of fixed asset, because this is the one which will guide me so that we do depreciation overcharge. Again, I check if there's revaluation gain. Checking in my question all of these items from additional information number one, we were told this in this additional information number one. We were told that on 1st July 2012, P Limited acquired 60% of the ordinary shares of S for a cash consideration of 10,000 million. At acquisition, the fair value of non-controlling interest in S was 6,500 million. P Limited wishes to use the fair value method of accounting for goodwill. On 1st July 2012, the fair value of the identifiable net assets in S was 14,000. So remember that we have net assets of 14,000 as told in the additional information. And the retained earnings of S were 1,200. The excess in fair value was due to non-depreciable land. The excess in fair value. Which excess in fair value? So remember that when I was doing my goodwill from the first part of this question, we said that goodwill is equals to purchase consideration you minus the net assets. But when we did that one, goodwill, when we were doing the aspect of goodwill, there was a revaluation, which they mentioned even in that additional information number one, that the excess in fair value was due to non-depreciable land. So the net assets from the statement of financial position, we have 10,000. That was this 10,000 plus there was share premium of 2,400. There was retained earnings, but remember that when you are doing goodwill, the retained earnings you use the one which is as per their date of acquisition, which is 1,200, which is the 1,200. So when we were doing goodwill, as per what is provided, if we add 10,000 plus 2,400 plus 1,200, so this one was giving us 13,600. That is why they mentioned that in that additional information number one, there are sentences. The excess in fair value was due to non-depreciable land. So the excess in value, so 14,000 minus 13,600, we got the 400. And the 400 is the excess in value, which is due to non-depreciable land. And that was our revaluation. That is our revaluation, which is provided there. So when we were doing goodwill, we called it a fair value uplift. Which is obvious revaluation. So that is what I'm supposed to add here. And remember that this is due to rand. The 400 is due to land, and land can never be subjected to any depreciation. Land can never be subjected to any depreciation. So for UPFA and the depreciation overchange, we don't have that because there is no sale of fixed asset. So what I'm supposed to do is just adding now my figures to get the property, plant and equipment, the consolidated one. So if I take 16,875 plus 10 to 30 plus 400, so I get 27,505. 27,505. So the next item to be consolidated is concerning now the investment. So how do you consolidate investments? So when we are talking about investments of subsidiaries, that one is replaced by goodwill. So the investment in subsidiaries. So the S. And remember that we got the goodwill of S Limited. We did this from our first part of the question. So you can check that one from the question we did, from the initial question. So this one was 2250. Then investment in A, remember that according to additional information, there's another investment which the parent made. So the parent acquired an associate. The parent had acquired an associate. Other than the parent acquiring subsidiary, other than P acquiring S, during the year you acquired A, 30%. That is what has been mentioned in the additional information given. So that is according to additional information number 5. On 1st July 2015, P Limited acquired 30% of the 1,000 million ordinary shares of 10 each in A Limited when the retained earnings of A stood at 1,000. A Limited had no other reserves as at 1st July 2015. As at 30th June 2022, the retained earnings of A were 3,500. No impairment was determined necessary in respect of the investment. So the 30% is an associate. So this is an associate which is acquired by the parent. So how do we account for the associates? Using which method? Account for associates using which method? Using the equity method. We use the equity method. So equity method is whereby you measure or you recognize the associate with the initial cost of investment. You add the share post-acquisition profit or reserve, then you raise the impairment. So let's do that. So the initial cost of investment, so you recognize the associate with the initial cost of investment. The initial cost of investment. So the initial cost of investment, according to note 5, you are told that on 1st July 2015, P Limited acquired 30% of 1,000 ordinary shares of shillings 10 each in A Limited when the retained earnings of A stood at 1,000. A Limited had no other reserves as at 1st July 2015. So as at 30th June 2022, the retained earnings of A were 3,500. So meaning that I need to check in the statement of financial position, and we are told that the investment in A is 3,650. So this one is given in the statement of financial position, the initial cost of investment. Then after talking about the initial cost of investment, remember that we are supposed to add the post-acquisition what? The post-acquisition what, my good reasoners? The post-acquisition retained earnings, because that is what I can see in that additional information. Retained profit or earnings, the post. So checking in that additional information, remember that our financial year was ending on 30th. Our financial year was ending on 30th what? 30th. Our financial year was ending 30th June 2022. So it was starting on 1st July 2021. When was A acquired? 2015. 1st July 2015. So As at that time of acquisition, the retained earnings was so P acquired 30% of 1,000 ordinary shares of shillings 10 each in A, when the retained earnings of A stood at 1,000. So this one was 1,000. A Limited had no other reserves as at 1st July 2015. As at 30th June 2022, the retained earnings of A were 3,500. Was 3,500. So how do you get the post-acquisition? Post-acquisition retained earnings. You always take the balance carried down, you deduct the balance as acquisition. Because now the balance as acquisition is included inside this balance carried down. So to get the post, you have to deduct the balance as acquisition from that balance carried down. You multiply with the percentage of acquisition. So 30% of 3,500 minus 1,000. So that is 2,500. So if I take my calculator and I take 2,500 times 0.3, so this one I will get 750. So 750 is what I add back to that 650. So that one gives me 4,400. So 4,400 is what I will record here. That is how you were supposed to account for the associates. So the next item you are supposed to consolidate as per the question given is all about the financial asset at fair value. The financial assets at fair value. So as per my question here, so this one was direct, the financial assets at fair value. So the financial asset at fair value is just a matter of adding the parent plus subsidiary. There was no even subsidiary, so it's just the figure for the parent, 6190. That one is 6190. Then we go to the current assets. Current assets. So under the current assets, we talk about inventory. So you take the parent plus subsidiary, 9980 plus 6930. Which adjustments are supposed to be done under inventory? Which adjustments are you supposed to do under inventory? So you minus or you add. So you are supposed to consider UPS and goods in transit. So meaning that you minus UPS, you add the goods in transit. You add the goods in transit. So UPS is due to the goods which were sold from one entity to another, but that other entity never resold the entire goods by the end of the year. Like now here, under additional information given, that is additional information number 3. During the year ended 30th June 2022, P Limited sold goods worth 2,000 to S. P Limited reports a gross profit margin of 25% on all its sales. Half of these goods were still in the inventory of S as at 30th June 2022. So meaning that half of the goods are the one which are unsold. So UPS is unsold goods. You take unsold goods times profit margin. Times profit margin. So the other entity which received those goods he never sold a half. So you take half of the selling price. So that is 2,000 times profit margin, which is 25%, is the same as a quarter. So 2,000 divided 8 was 2 times 4 is 8. So that is 250. So that is the UPS. That is the one I will minus here, plus goods in transit. If there was goods in transit, you know that the goods in transit you add under the inventory, and at the same time you add under the payables, because these are the goods which were sold from one entity to the other, and they were on credit, but that other entity never received them by the end of the year. So for us to record them, remember that we need to add to the inventory, that is, you debit, and at the same time, since the other entity never received them by the end of the year, so it means that they were on credit. He had not settled their value to the seller. So meaning that we have to increase our creditors balances by again crediting. So that is why I consider goods in transit here and under payables. So anyway, it's understanding the adjustments which are done. So I've said here we have UPS. So after we have done that, it's just a matter of adding the two items. Then we deduct 250. So 99.80 plus 69.30 minus 250. So that is 16,660. 16,660. Then the next item to consolidate is all about trade receivables. Trade receivables. So for the trade receivables, 94.80 plus what? 65.80. So what am I supposed to adjust under trade receivables? You are supposed to raise intergroup owings. So the amount which has not been settled by one entity. So the amount which was due. We are not supposed to carry forward to the next financial year. So an amount which is due between the parent and subsidiary is supposed to be forgone in the current year under consideration by crediting receivables account and then you debit the payables account. So we check in the question if there is any outstanding balances. But according to this question, the way I can see the additional information, there is no outstanding balances. There is no entity which owes it the other any amount, either P, S, or A. But we don't eliminate, even if A could have having some amount outstanding to P, we don't consider intergroup transactions or intertransactions with associates. We don't eliminate them. We only consider, or we only eliminate, we only adjust items between the parent and subsidiaries. For the associates and joint venture, under this statement of financial position, we only account for them using the equity method. That is what I have already done. So it's just now a matter of adding these two items, 94.80 plus 65.80, 16,060. So the next thing we consolidate is all about cash and cash equivalents. So the cash and cash equivalents. So again, cash and cash equivalent, we add the two. So 54.90 plus 38.15. So let me mention something here about what you are supposed to adjust under trade receivables. Then we talk about cash. So I've said under trade receivables, under the receivables, what you are supposed to raise is all about intergroup owings. Intergroup owings. Again, you minus cash in transit. Then when you go to cash, you are supposed to add the cash in transit. But there was no cash in transit now to be adjusted here. There was no even intergroup owings. So meaning that we just add, again, the two items given, 54.90 plus 38.15. So you get 93.05. So meaning that we are already done with the consolidation of assets. We are done with the consolidation of assets. It's not a must you add to get the total. This one will be added later for you to get total assets. So let's move to equities and liabilities. Let's move to equities and liabilities. So we talk about ordinary share capital. So remember that for ordinary share capital, we are supposed to pick the figure for the parent only. So this is another free mark, 20,000. For the parent only, the 20,000. So then again for the share premium, we take again for the parent only. Share premium, parent only, that is 4,000. Then when we move now to the retained earnings, we need to do a working, and I have to introduce other items here. So retained earnings, so this one requires a working. So then I will introduce non-controlling interest. Another working which is required. Then I introduce other components of equity. Other components of equity. So another working. So we move to the question. We talk about non-current liabilities. Remember that this is total equity. Before I talk about non-current liabilities, so we talk about non-current liabilities. So for the non-current liabilities, from my question, I can see 10% loan notes. 10% loan notes. So the 10% loan notes, I get parent plus subsidiary, 10,500 plus 3,500. Deferred tax, parent plus subsidiary, 6,150 plus 1,870. So this one doesn't require any adjustment. It's just taking the parent plus subsidiary. You can see, students, how this question was easy. Most of the transactions was just adding parent plus subsidiary. You get your mark. Parent plus subsidiary. You get your mark. What a wonderful exam was it? What an easier paper was this one? So then we talk about so I can see here now we move to the current liabilities. So for the current liabilities, we talk about trade payables. So trade payables again is just adding. That is 5,700 plus 3,100. So I only said that we can adjust some few items under trade payables if they are available. That one being goods in transit and owings. So the intergroup owings, the one we could have deducted under the trade receivables, the one we could have credited under the trade receivables, we debit under the trade payables. So we minus under receivables, we minus under payables. That is the intergroup owings. Then I said the goods in transit, the one which is added here, once we debit here, because it was goods in transit, or which this value of the goods has not been settled by the relevant entity. So other than recording them here, we need to do what? To increase the creditors balances by again adding under the trade payables. Adding under the trade payables is crediting. But they were not available. So what am I supposed to do? Just take the figures of the parent and subsidiaries, sum them and give us the figure. That is the consolidated trade payables. 8,800 Then finally, we have the current tax. We have the current tax. So the current tax, I take 1645 plus 735. 1645 plus, so 1645 plus 735. So this is 2380. There's nothing to be adjusted under the current tax. So that is total equity and liabilities. Total equity and liabilities. So I will be doing the workings for these three items: retained earnings, non-controlling interest, and other components of equity. But what can I advise a student? You are not even required to do that workings in an exam setting, because it will be wastage of your time. Like now, they were in need of 14 marks in this question. What we have scored is more than 14. So you have the maximum 14. Because if I count my entries, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Even if they decide to give you 1 mark for 1 entry, you have 13 out of 14. But because I know how they marked this, the funny thing is that they were in need of only 7 correct entries. They multiply by 2. 7 times 2, you get your 14. So already we have more than 7. So meaning that you have the 14, the maximum marks. So anyway, for the other purposes, maybe you need to understand how you do retained earnings and controlling interest and other components of equity. We can do them. So let's do the retained earnings, the workings of retained earnings. Then I do the non-controlling interest. But non-controlling interest, already we did that one. Already we did this one from the first part of the question. So I don't have to repeat again. So because I said I would attach the link to that video in this video today. So this one was 4150. So this one is already solved. So you watch the first video, you would understand on how I arrived at this 4150. So I do two workings. So for the retained earnings, let's do it using this T account, of which we have to start by considering the retained earnings of P Limited. So the retained earnings of P Limited is 16,670. So 16,670, that is according to the statement. The 16,670. Then now we consider S Limited. But for S Limited, we consider the share of post-acquisition retained earnings. The post-acquisition, that is what I will consider here. The post-acquisition. So the post-acquisition, and remember that while considering this post-acquisition, you have to remember initially there was 60, then there was an additional 20. So put that into consideration. So here I will talk about 60% times the retained earnings in the statement of financial position, which is 5950. To get the post-acquisition, remember that I said we take the balance carried down minus the balance asset acquisition. So we minus the balance asset acquisition, which is 1200. That is according to addition information number 1. You are told that the retained earnings of S were 1200. Then this initially from the time of acquisition plus. So now here we need to add. We need to add, and I need to arrange this well. So we need to add. So we have said 60% times 5950 minus the 1200. So this the retained earnings balance carried down minus the one asset acquisition to get the post. Then plus now the 80% by the end of the year. The 80% times the additional retained earnings which was there. So as at the time when they acquired this additional 20% through a cash consideration of 3,000, S reported a profit for the year ended 30th June 2022 of 500, which accrued even throughout the year. So that is what I would apportion for the 6 months. So 500 times 6 over 12. 500 times 6 over 12. So let me use my calculator to get those figures. So if I take 5950 minus 1200 times 0.6 plus 0.8 times 500 times 6 over 12. So what am I getting? I'm getting 3050. That is a 3050. So that is for S. We're considering the aspect of the 20% additional. Then for A limited, we consider the post. We consider the post acquisition, of which we already did that working, and it was 750. So remember that we did the post. We took 30% of the balance carried down. So the balance carried down for the A, according to note 5, it was 3500 minus 1000. 3500 minus 1000. Then we multiplied with 30%. We got 750. So that is what you could have considered on the credit side. So P, S, and A. Then on the debit side, you consider UPS. So UPS was this one, the one which has been credited in the inventory. So we debit here. Then another thing we consider is all about concerning impairment. So when we did goodwill initially, in our first part of this question, our impairment was 250. So we need to consider 80% of 250. And again, we need to consider the 60% of the 250. You understand those changes of percentages of acquisition. So 80% of 250, that is 200. Then 60% of 250, that is 150. Then from there now we can determine the balancing figure, which we are supposed to record in that statement of ours. So 16,670 plus 3050 plus 750. So this is 20. This is 2470. You have 2470. So the balancing figure here would be, so if I minus 250 plus 200 plus 150, so I will get 19,870. So that is what I will record here. I don't think if there's any student who scored these retained earnings in that exam, but for my students, I know that they might have scored. The one who attend my online classes. So let us do the other components of equity. So the adjustments which was required there. The other components of equity. So adjustments to NCI and other components of equity. So adjustments to NCI. So adjustments to NCI and other components of equity. Adjustments to NCI and other components of equity. So we talk about proportionate reduction in NCI. So it was 40% and it reduced to 20. You divide the 40 times the NCI as at 1st January 2022, the one we got from the first adjustment we did. So it was 8,300. So you check this one from the first working, which I was doing, from the first video, when I was doing the NCI, when I was computing for the non-controlling interest. That's NCI we got as at 1st January 2022. So this one is the half of this, which is 4150. Then less additional consideration, which they paid. Additional paid. So when they acquired the additional 20%, they paid how much? That is according to note 2. The cash consideration of 3,000. The cash consideration of 3,000. That is what you are supposed to reduce there. So meaning that here there is an increase in other components of equity. Increase in other components of equity. Other components of equity. By which figure? So we have 4150 minus 3,000. That is 1150. So 1150 is what you are supposed to record in that statement of ours which we were doing. The 1150 here. But these are some of the workings which were not even necessary. But this one was necessary because the first requirement was determine and controlling interest. So you need to understand them. So let's check if our statement, that is, statement of financial position, we have prepared is balancing. So 27,505 plus 2250 plus 4,400 plus 6190 plus 16,660 plus 16,060 plus 93,05. So that one, I'm getting 82,370, 20,000 plus 4,000 plus 19,870 plus 4150 plus 1150 plus 14,000 plus 8020 plus 8,800 plus 2380. So that is fine. It's balancing. 82,370. 82,370. The same as for the assets. So that is how you were supposed to do this question for consolidation for August 2022, meaning that we have done the entire question. So if you check the first part of that question for 6 months, for 6 marks, then you come and watch this one. It means that you are done with that question for consolidation for us sitting. Welcome for the ongoing online classes. We do more intensive classes at a very small cost. So never be left out. These videos can be additional, but in class, you will have an opportunity to interact with me. Ask whatever question you could ask that is relevant to what we'll be doing. And at the same time, we'll be able to tackle more questions than what I have shared in this platform. So never miss out this opportunity for attending the live classes, which are ongoing. We are now entering in a crucial time whereby I'm doing earnings per share, reconstruction, cash flow, and group accounting. And those are the areas which contribute more than 70%. So thank you for your contribution to this channel, and remember to share this video to your friends who are doing advanced financial reporting and who are doing another accounting course which is related to what we are doing. Again, I remind you that never just watch without subscribing. Subscribe. Thank you for your time.